From the fact that we've rallied so far back from an equity standpoint, I mean, what is your general view of the markets right now relative to what you were talking about that you were just referencing, this disorder that we had in large swaths of the market to where we are today?
Yeah, the markets pretty much recovered, obviously, because of the Fed on April 9th in particular, taking the bold step of pretty blatantly violating the Federal Reserve Act of 1913. I mean, the Federal Reserve cannot buy corporate bonds. Now, I know that they're not technically buying corporate bonds, but they're doing it clearly by sleight of hand and in a semantic sense not doing it, but they're certainly doing it. But since April 9th, what's interesting is the LQD ETF, which is investment-grade corporate bonds, have been meandering lower. That was actually their high day, was when the Fed came out with their initiative to buy even corporate bonds. And JNK is one of the high-yield ETFs, same thing. It's not falling a lot, but you're right, these things are up way off their lows. LQD looks to be about the most overvalued asset in the bond market to me, because the prices got all the way back to within 3% of their highs thanks to the Fed move after a huge decline. Now, the Fed action has certainly slowed that up. JNK has retraced, similar to the stock market, about half of its decline. But all of these markets are looking quite tired these days, and the sentiment shifts should have investors concerned. I mean, I was watching a segment on CNBC earlier this morning. It's talking about how people are looking for aggressive opportunities. You know, the time for aggressive opportunities was March 23rd, not April 27th. So I think that the markets really are celebrating the idea that, you know, the cases are slowing down, and they're talking about opening up maybe even New York City and all that stuff. But I would caution investors to beware of panaceas like this, where, you know, test, you know, that's going to be the answer to all of our problems, and open the economy. There's the two kind of catchphrases that you hear a lot of. And certainly those things are better than not having those things. But I think many people don't understand the wide-ranging ramifications of this societal shift that's going on. One of the things that I like talking about, for example, is the CARES Act with its PPP sort of aspect of payroll check protection. It actually gives people, many people, a lot more money for not working than what they had when they were at their job before they lost their job or got furloughed. I mean, a lot of people are making 25% more. I have family members who have pointed this out to me, who said, this is amazing. I've lost my job, but I'm making more money by not working, thanks to the $600 per week bonus in the unemployment benefit. And that just makes the cost structure of reopening these businesses really prohibitive. I mean, businesses where a lot of small businesses barely make it week to week prior to the COVID-19. And if you increase their cost structure in terms of getting employees back by 25%, it's almost impossible for them to open. We keep talking about restaurants reopening and talking about removing half of the tables in the restaurant is one idea. Well, most restaurants make 5, and if they're super lucky, a 10% profit margin. You take 10% of the 50% of their tables away. Sure, their cost structure might be reduced because they don't need as many wait staff and so on, but there's no way they can make any money. So I just think other things, state and local problems are certainly going to accelerate and become a greater part of people's awareness. So I'm certainly in the camp that we are not out of the woods, and that you know, the stock market's had a big recovery, which isn't all that surprising, given that everybody and their brother said, we're going to get a retest of the low. We're going to retest that March 23rd low. And, of course, the opposite happened. We ended up roaring back.
Do you think, is that now off the table? Is it off the table now, retesting the low because of the Fed?
No, it's not at all. In fact, I think we take out the low. I think a retest of the low was very plausible. A lot of us have been around a lot of years, almost fell victim to our historical experience and expecting that relatively soon retest of the Dow Jones below 19,000 industrial average. But I just don't think that's going to happen. I think that people don't understand the magnitude of social, I'm not going to say unrest, but social unease, at least, that's going to happen when you have what's now 26 million plus people have lost their job. We've lost every single job that we created since the bottom in 2009. Every single job is gone. Now, they're not the same jobs. I'm just talking about the count, the number
Sure.
of employment count. I mean, that's just incredible. So we have zero interest rates. We have quantitative easing, which is vastly greater in 1 month than all of the quantitative easing in the history of the United States until a month ago, right? And so in a certain sense, we're really kind of never left the global financial crisis, if you think about it. Our unemployment rate is now worse. We've lost all the jobs. The policies that we put in place, zero interest rates and massive quantitative easing, well, we're back at them again. I think investors and citizens have to ask themselves, we thought that the weird policies of 2008, 2009 were supposed to fix things, but now we're doing them on steroids. And so are we ever going to leave these policies? If it took us 12 years to get back to these policies, what's it going to take next time to get back to them? 5 years? I mean, these things probably have a half-life. So I know that the virus is obviously the massive catalyst for all this stuff. But I think what people don't understand is the debt-based economic scheme of the United States I've been talking about for a long time has really been revealed. I mean, I've seen numerous people come on CNBC over the course of the last year and point out that a large fraction of Americans don't have any rainy day fund, that they can't absorb an unexpected expense of a few $100s. Well, we now have seen that happen, and I've got to believe that this has traumatized an awful lot of people. And maybe we'll actually get back to a strange, quaint notion called saving. And it's, in fact, like buying things after you save the money for them, like we used to do, 40 years ago before we went into this debt-based economic scheme. And furthermore, I think the problem with these bailouts, they're unfortunately very top-heavy again, because that's really the only practical way to administer these things. I mean, when the economy absolutely collapses like it did a month ago, it's very, very difficult to scramble and try to supply rescue relief, except through really the channels that are already open, which tend to be large corporations and those industry groups that are well connected.
You're referring in part to the 13 or so publicly traded companies that accessed that money, and many of whom are now giving it back. It was obviously far from a perfect environment.
Oh, sure.
Yes, the speed, of course, you have to take into consideration, as you just referenced, but companies like the ones that were taking money are the ones you're speaking about.
Well, I'm not.
Some of them.
I mean, that's a subset of what I'm talking about. I'm really talking about the massive bailouts, and I know they're now talking about the oil and gas industry is another type of bailout, but the airline industry is kind of the poster child. It really is. I think people should be frustrated that these airlines spent a huge fraction of their free cash flow on buybacks in recent years, and now are being bailed out to a degree of cash that's higher than the amount of bought back, the dollar amount bought back. It's like the government. You have these companies that leverage themselves up to the hilt, and were not very well managed. Therefore, just push to get the stock price up and to get the earnings financially engineered. And now we're essentially buying back, in a sense. I mean, I know this isn't literally the case, but in a sense, they bought back $45.5 billion of stock.
Right.
Now we're buying it back at a profit, in essence, at a higher value.
Yeah, you are certainly, you have company, you have a lot of company in that criticism. You could bring up Carnival Cruise Line, for example, as well. Your point there, Jeffrey, is well taken. And like I said, you're not the only person who is raising the issue of bailouts, what they mean to the fundamentals of how capitalism operates. For example, I'm not sure if you had followed the conversation that I'd had over the last couple of weeks with Chamath Palihapitiya, who raised similar concerns about buybacks. I'm sorry?
Right. I did listen to that conversation. I thought it was really fascinating and really, really food for thought and debate. I also think it's not just bailouts, though. It's not just buybacks. I mean, certainly there shouldn't be buybacks for companies that are repeatedly needing assistance. That's ridiculous. But beyond that, what about the way people live their personal lives with cash-out refinancing of their houses, just borrowing money all the time to go on, pretty lavish and extravagant vacations and buying, really expensive phones and all this stuff. I think we should really think as a society about limiting this debt-based motivation. A friend of mine actually unbelievably had a child, and their child, when they were 6 months old, received a credit card application in the mail. I mean, it's really. When I was a teenager, when I first was coming of age, I remember getting my first credit card, and I had to apply for it. I sort of couldn't believe they accepted me. And actually, you had this weird feeling of pride, like, hey, I've got a credit card, like I'm deserving, I qualify, I've sort of made it in society. But this has gone wild, where everything's just based upon borrowing money, cash out refinancing. I mean, car loans that are many, many years in term. I mean, I think we should think seriously about demotivating people to just constantly borrow and be in a position where when the downturn happens, and it always eventually happens, they're forced in a situation where they're destitute, basically.
I think that could be one of the things that maybe develops on the other side of this, is you have a fundamentally different way that maybe people think about their lives.
Absolutely.
But that also has a ramification, doesn't it, on the economy on the other side and growth?
It's very positive for the long term. Unfortunately, when you finally have to take the medicine of getting off of a lifestyle that you basically can't afford, you have to shift down to a lower level. And that's why I think we're looking at a lower low in the stock market, because these things are going to make themselves known with a lag. Like, what about state colleges and universities? I've been reading articles about what if they don't reopen. I mean, I know that might be a pessimistic case, of course, but if they don't reopen, these state college universities, they're not going to be able to survive. We're talking about colleges, universities, potentially basically closing down because of financial reasons. And I don't think people understand the state and local government consequences of what's happening here. I was listening to the radio, and Mayor Garcetti last week said that the city of Los Angeles is in the worst financial condition in its history. Yet 3 months ago, the financial condition of Los Angeles was pretty good, at least over the short term. So this unemployment and the tax hit, and then the tax holidays, and the don't pay your rent, the way that filters through the system. So still, there's a lot of really serious structural damage that's been done. And I think those of us that follow, the stock market averages day by day and see that the corporate bond market has recovered thanks to the Fed, I don't think that they really understand what it's like out there in the real world. Go ahead.
I understand. I'm sorry. It's just our time always goes too fast, and we don't have that much left. I want to get you to comment more on what the Fed has done. I know you tweeted specifically about the buying of the high-yield ETF. I was reading an interesting article in the Journal today, and maybe you saw it as well, on these extraordinary and unprecedented measures that the Fed has taken, Jeffrey. And there was a quote in there from Janet Yellen that I wanted you to react to, if you would. She said, this is why, of all of these extraordinary measures and the things that the Fed has done it and still, frankly, may do, this is why the Federal Reserve was invented, she said, to do emergency lending in a crisis. And others have made the comment, too, that maybe no one wanted to be in this position, but we are in this position, and thus we need, desperate times call for desperate measures. And this, Janet Yellen says, is what the Fed's here for. What's your reaction to that?
Well, I think the Fed is not created to just be a fireman, when there's a fire. I think the Fed is supposed to put fire prevention measures in. I mean, the Fed is not supposed to just wait for, gun interest rates down at zero for long periods of time, to not put up reserve requirements after, say, 1996, that is irrational exuberance. I mean, there used to be conservatism at the Fed where they'd say the job of the Fed is to take away the punch bowl when the party's really getting rolling. Well, we didn't do that at all. I mean, we had a 129-month expansion, which is the longest in U.S. history, which in and of itself tells you that something unnatural is going on. And the country's been around for over 200 years, and we've never had an expansion ever that looked like the one since the global financial crisis, and now it's been completely erased. So yeah, I mean, now that you put yourself in this position, Fed, yeah, I guess you have to do reactive things, because if they hadn't done anything in March, I mean, you just would have got a total collapse. I mean, the bond market in March, in the high-yield market, even the investment-grade corporate market, and the CMBS market, there was no bid. I mean, you simply couldn't. It was much worse than 2008 or early 2009, much worse. And that's why it's comical that I think about how we spoke a little over a month ago, that people were talking about how the market was looking a little shaky. Well, they didn't have any idea what was coming. There was literally no bid. So the Fed had had to do something in reaction to that, and they certainly came in strong. But it's unfortunate that what people like Janet Yellen don't seem to want to take responsibility for is they're also part of why we got towards this problem with the very low interest rates, and the Treasury Department's to blame too, because as I've been talking about in my webcast over and over again, there was no economic growth in 2019. It was all debt. National debt grew more than nominal GDP. 2019. What other thing a lot of people don't understand is that the 2019 economic growth was basically all consumption. It was all consumer debt. 90% of the GDP in 2019 was consumption. Usually consumption's around 70% of GDP, but in 2019 it was basically the only game in town was consumption. But what happens now if we go back to 70% of GDP as consumption? In other words, that consumption drops, so that it goes back to what would have represented more.
Sure, but we were in an environment, as you say, right? We had manufacturing was dislocated because of the trade war. We were overly reliant on the consumer and consumption, and now you've basically locked the consumption metric into a room. I've got 3 minutes left, Jeffrey. And look, one of the last times we spoke, you had said several weeks ago that you had closed out the last of your S&P shorts.
That's right.
But you
now it's over 19,000.
Do you have more on now because you think we're going to take out the lows?
Actually, I did just put a short on the S&P at 2863. So at this level, I think the upside downside is very poor, because I see really, really tough sledding to try to get the S&P above. Let's just pick a round number, 3,000. I don't think it's going to make it to 3,000, but it could. 2980 looks like a really tough level to me. And so I think that this is a bad trade location. I think we have downside easily to the lows or beyond, and the upside looks like it's about 3 or 4%. I'm not nearly where I was in February, where I was very, very short, but I have started to build a partial short position around these levels.
Mm-hmm. Well, so what then is your best trade, would you say? What is the best trade for our viewers who are listening to you and follow you intently? What is the best thing to do in the market today? Is short the S&P the best idea you have? Or is there something on the credit side, or is it something else? Commodity related?
Commodities, no. I think right now investors are supposed to be in high liquidity. I'm basically 50% cash. At this present time, down from 100% cash where I was in the middle of March, because of my position is actually on the short side. But I don't really like much of anything right here, because the markets have all adjusted higher, and I think that there's more trouble coming. Commodities, the problem with commodities, we saw the negative oil price, and that's because commodities is a totally screwed up market, because there's all these speculators that don't have the ability to deliver, and they certainly don't have the ability to take delivery. We saw that with the oil thing last week. And these people are just speculating, and they have absolutely no ability. They don't even know how to take delivery. And this, I think, is happening in the more speculative commodity markets. I think one of the things I talked about on our webcast, it's up on replay at doubleline.com, A Tale of Two Sinks. I talked about how it bothers me how much speculation there seems to be in paper gold. A lot of people have made money on gold, and gold's got a very good trade for the past couple of years. But what if the people who are speculating on the long side of gold actually decide one day to take delivery? I'm not sure what would happen, because I'm not sure there is enough physical gold to deliver into the paper long. And so I just think the commodity markets need to be seriously reconsidered and maybe regulated more in terms of who's allowed to be long and short these contracts. So commodities to me just looks like a dangerous market on the speculation side.
Mm-hmm. Jeffrey, the time went too fast. It always does. Let's revisit this conversation in the weeks ahead. I do appreciate your time very much today. You be well.